Everybody talks about how the middle class is shrinking, but most people have no idea of what that actually means, which is why in this video, I want to go over what's happening to the middle class, and then I want to discuss how you can build wealth despite the changes in our economy. Take a look. In 1971, the median household income in America was $10,290, while the median home in America was selling for $25,200, which was about 244% of household income. At the same time, the median new car in America was selling for $3,918, which was 38% of your household income. And if you wanted to go to a public four-year university, the average college university then cost about $394 for 1 year, which was about 3.8% of 1 year's household income. Now let's fast forward to 2019, because in 2019, the median household income in America jumped up to $68,703, while also the average home price in America jumped up to around $258,000. Now, to compare apples to apples, what we'll see is that now in 2019, you're paying about 375% your median household income to buy a home. Car prices jumped up to $38,363, which is now about 55% of your median household income of 1 year. And with college tuition jumping up to $10,440, that is about 15% of 1 year's household income. But things have changed quite a bit since 2019, so let's fast forward to 2024, where now the median household income has jumped up to $81,000, which sounds good, but let's compare the household income to the price growth of things that people buy. The median house in America is now selling for around $433,000, which is about 534% of your median household income. The average new car in America is selling for $47,800, which is about 59% of the median household income. And of course, not surprisingly, college tuition has also jumped up to $13,700 a year for an average public four-year university, which is now about 19% of 1 year's household income. But this is really just the beginning. Wait till you see how the government spending and government debt ties into all of this. But what you can see from this trend is that while incomes have increased from 1971 to 2019 to 2024, the price growth of other things that you need, like your house, your car, and your college, have outpaced the household income growth. Not to mention the fact that back in 1971, household income was primarily determined by one person's income, because back then, generally the man went to work and the woman didn't. And in 2024, household income is primarily determined by two people's incomes, because now we have two income households. And even then, the growth of household income has not kept up with the growth in housing prices, car prices, and college prices. And you might be wondering why. So let's dig into that. But first, let me remind you that if you'd like to stay up to date on what's happening in the financial markets when they're happening, but one way that you can do that is by joining Market Briefs. It's a free newsletter that I created where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, the crypto market, the global economy, and of course our own economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning. We have over 250,000 investors reading Market Briefs every morning. So if you'd like to join, all you gotta do is click the link down in the description below to join Market Briefs for free. In 1971, the United States economy, or GDP, was $1.1 trillion and our national debt was $398 billion, which means we had about 36% national debt to GDP. Fast forward to 2019, and now you can start to see how the numbers begin to change, because in 2019, we had an economy, or GDP, that was $21.3 trillion large, and our national debt in 2019 was $22.7 trillion, which means we now have a 106% national debt to GDP. More national debt than the size of our economy. And now here we are in 2024, and the numbers have not gotten better. In 2024, the GDP is expected to be $28.7 trillion, and the national debt at the time of me recording this video is $35.4 trillion. This number will be higher by the end of 2024, but just to be generous, let's assume that our national debt stays at $35.4 trillion, which means that our national debt to GDP is about 123%. This is where you can start to see a little bit of a correlation. The United States government goes out and borrows more money, and as the United States government is borrowing more and more dollars relative to its GDP, life gets more expensive faster than the household income. But that's not all. Let's also take a look at the national deficit in the United States, because what the national deficit is, it's when the United States government spends money that they don't have over the course of 1 year. So for a hypothetical, if the United States government were to generate $1 trillion and then they spent $1.5 trillion, their national deficit is $500 billion because they spent $500 billion that they did not have in tax dollars. So let's take a look at that. In 1971, the national deficit was $23.2 billion, which meant the United States government spent just over $23 billion that they did not generate from taxes, which was about 2.1% of GDP. By 2019, the national deficit jumped up to $984 billion, which meant the government spent almost $1 trillion that they did not have. This is now about 4.6% of our GDP. And now here we are in 2024, and the national deficit is expected to be $1.9 trillion, which is about 6.6% of GDP. What does that mean? Not only is the government spending more money that they don't have, but they're accelerating the rate at which they spend money that they don't have. They're accelerating the rate at which they're spending on this national deficit, which could also be contributing with the prices of things rising faster than incomes. But let me take this one step further. That way you can understand how really the middle class has been shrinking while the people that are wealthy keep getting wealthier. In 1971, the stock market, more specifically the S&P 500, was trading at around 98 points. By 2019, the S&P 500 jumped up to 2,900 points. And now in 2024, at the time of recording this video, the S&P 500 has jumped up to just over 5,700 points. Now let me show you why this matters. Between 1971 to 2024, the household income, the median household income in America has jumped up by around 700%. While at the same time, the stock market, the S&P 500, has grown by around 5,700%. By the way, I'm rounding up on the household income numbers. I'm rounding down on the stock market numbers. This is why the middle class has been shrinking. The prices of things have been rising faster than incomes, while at the same time investment values, like the stock market, have been rising significantly faster than the prices of things, and they've been rising significantly faster than incomes. So if you were an investor, you've become wealthier. If you rely on your salary, you've become poorer. Now, what do we also see happening at the same time? Well, we've also been seeing government spending ramp up year after year after year, decade after decade after decade. And along with that, the national debt has been growing and a national deficit has been growing. How does that relate to the prices of things growing faster than incomes? Well, this goes to what is inflation and what causes inflation. Who does the United States government owe this $35 trillion to? And the answer is, well, it depends, because they owe this money to regular people, because you can lend money to the United States government, but there isn't enough private dollars out there to loan money to the United States government. They owe some of this money to foreign countries like Japan and China, but there's also not enough foreign investors, foreign governments to invest this much money to the United States government. And this is where the United States government then borrows the rest of this money from the Federal Reserve Bank. The Federal Reserve Bank is the central bank here in the United States, but they don't have trillions of dollars just sitting there to lend to the United States government. So for the Federal Reserve Bank to lend these trillions of dollars every year, this national deficit, to the United States government, the Federal Reserve Bank then has to go out and create this money out of thin air. Now, our money, or at least what we call money, our currency, our dollars, they're just pieces of paper. They're not backed by any sort of precious metal or any sort of thing that says that this $1 has a specific amount of value. It's just a piece of paper. So now when you keep printing and creating more of this dollars out of thin air, what happens is the value of each individual dollar goes down, which in turn causes the prices of things to go up. So you continue working hard at your salary trying to get a raise, but the problem is your raise doesn't keep up with the price growth of other things. And this didn't just start after the pandemic, after 2020. This has been happening for many decades. And the problem with this is the average person doesn't see this happen. And when you don't see this happen, you don't do anything about it. You continue going to work, trying to get a good salary, trying to make ends meet, but then you don't figure out why you keep struggling. When in reality, not only do we have more household income earners today, we have 2 income earners today versus 1 income earner back then, we still haven't been able to keep up. And this is why it is so important, so important for you to become financially educated, for you to become an investor, because the reality is the middle class is shrinking. Why is the middle class shrinking? Because more and more Americans cannot just rely on one salary to pay for their house, their car, their college. More and more Americans can't rely on 2 salaries to pay for the house, their car, and their mortgage. And so you have to anticipate what's going to happen in 2034 or 2044 or 2054. Are we going to go back to 1 income households, or are we going to need 4 income households? And this is where, again, understand this economic system. Our economic system is designed to benefit investors because inflation generally benefits investors over the long run. Now, does that mean that investments ever go down? Of course investments go down. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, which is why you gotta always do your own due diligence and never blindly trust a random guy on YouTube. But the whole idea behind this is we know that over the long term, investments have gone up. The stock market has gone up. Housing prices have gone up. We've seen stock market crashes. We've seen housing market crashes. But if you know what you're doing, well, now you can build wealth in this system that's designed to benefit investors. But that requires you to, number 1, understand what's happening. Number 2, have the money to invest. Number 3, have the financial education to invest. And then, of course, understand the financial trends so you know where to actually invest your money. But it starts with you understanding how our economy is changing and how our economy is designed to benefit investors and how it's not designed to benefit consumers and employees. It doesn't mean you shouldn't be an employee. There's nothing wrong with being an employee. The key is to take some of the money that you're earning as an employee and take that money and turn it into assets, turn it into investments that can continue to grow in this economic system, because the average person is not an investor. The average person is just a consumer. They make money to spend it and then spend some more with debt, and then you wonder why you can't get out of the rat race. You have to understand our economic system is designed to benefit the investor, is designed to benefit the financially educated, and in order for you to win in this system, you have to become an investor as well. We just entered the next phase of the global economy. The Federal Reserve Bank is now cutting interest rates. Canada is cutting interest rates. China is now cutting rates, and countries across Europe are also cutting interest rates. And we've also seen some countries, on the other hand, now start to protect themselves against any sort of potential economic uncertainty by buying things like